What if the biggest threat to the AI boom isn't regulation? Not competition, not even a recession. What if it's the finance department? Because this week, Uber revealed something that investors may have completely overlooked. The company has started limiting how much employees can spend on AI coding tools after burning through its AI budget much faster than expected. At first glance, this sounds like a routine budgeting decision. But it may be one of the most important AI stories of the year. Because for the last 2 years, the market has operated on a simple assumption. More AI usage means more productivity. More productivity means more profits. More profits justify the hundreds of billions of dollars flowing into AI models, cloud infrastructure, data centers, and Nvidia chips. Uber just exposed a potential flaw in that logic. What if AI usage grows faster than AI profits? Because those are not the same thing. To understand why, we need to look at what makes generative AI fundamentally different from most software that came before it. Traditional software was usually sold through subscriptions. A company paid a fixed fee. Employees could use it as much as they wanted. The economics were predictable. Generative AI changes that model completely. Every prompt consumes compute. Every coding request consumes tokens. Every AI-generated answer creates another bill. The more employees use it, the more expensive it becomes. That sounds manageable until adoption starts exploding across an organization. Uber says AI is already helping generate roughly 10% of its code. Usage is spreading across engineering, legal, and marketing teams. Those numbers sound incredibly bullish. But buried underneath those adoption statistics is a much more important detail. Uber executives have openly admitted they still cannot clearly connect this explosion in AI activity to a proportional increase in customer-facing products. That statement should matter to investors. Because if an engineer writes twice as much code, but customers don't receive twice as many useful features, the company hasn't doubled productivity. It has doubled consumption. And that distinction may define the next phase of the AI boom. Right now, investors are rewarding AI companies based on usage growth. More users, more prompts, more tokens, more compute, more GPUs, more revenue. The entire chain depends on demand continuing to accelerate. Corporate customers buy AI tools. AI providers buy cloud capacity. Cloud providers expand data centers. Data centers order more servers. And eventually someone places another order for Nvidia chips. The market has spent 2 years assuming this cycle can continue indefinitely. Uber just reminded investors that demand has a budget, and budgets create limits. Because every spending cap imposed by a customer becomes a revenue cap for somebody else. A limit on token usage becomes a limit on compute consumption. And a limit on compute consumption makes future infrastructure expansion harder to justify. That matters because the largest technology companies in the world are currently spending hundreds of billions of dollars building for future AI demand. Microsoft, Google, Meta, Amazon. All of them are racing to build the infrastructure needed for an AI-powered future. Those investments make sense if token consumption keeps accelerating. They make less sense if corporate customers start putting ceilings on AI spending. And that creates a tension that investors have barely started discussing. The technology can be useful, employees can become more productive, companies can absolutely benefit from AI. But that does not automatically mean spending grows forever. And today's valuations often assume exactly that. Because the market is not valuing many AI-related companies like ordinary businesses. It is valuing them as foundations of a new economic revolution. That means expectations are extraordinarily high. The assumption is not just that AI gets adopted. The assumption is that adoption translates into massive profits. Uber's spending cap does not disprove that thesis, but it does challenge one of its foundations. It reminds investors that demand is not unlimited. Every CFO has a budget. Every company has cost constraints. And every management team eventually asks the same question. What are we getting for the money? That is why this story matters. Not because Uber capped spending, but because it may be the first visible sign that the AI industry is entering a new phase. For the last 2 years, the battle was adoption. Today, adoption is happening. The next battle is monetization. Can AI create enough economic value to justify everything being built today? That question may determine the future of the entire AI trade. Because AI vendors need growing token consumption. Cloud providers need growing compute demand. and investors need both to justify today's valuations. If AI creates enormous value, the current investment boom may still be in its early stages. But if corporate America discovers that token spending grows faster than business value, investors may be forced to rethink some of the assumptions supporting the most valuable companies in the world. And that may become one of the most important market questions of this decade. Because the future of the AI boom may not be determined by how many people use AI. It may be determined by how much companies are willing to pay for it. And if that willingness has a ceiling, then the biggest risk to AI isn't a lack of adoption. It's that hundreds of billions of dollars of infrastructure were built for demand that never arrives. This is Macro Pulse, Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell.